Hello, everyone. My name is Pieter Dree, and I welcome you to this next episode of the PwC Tax Bite podcast series. A lot of things happened today, a lot of publication of the European Commission, so we should have a discussion on that. And I'm very happy that I could find in this year-end period two experts to have this discussion with me. First of all, Isabel Verlinden. Isabel is PwC's corporate tax strategy partner, and Jean-Philippe van West. Jean-Philippe is well known in this podcast series, of course, and he is our European law expert. So, yeah, happy that you're all here today, Isabel and Jean-Philippe. What a productive year for the European Commission was it? We saw the DAX 7 being adopted. We saw plans for business taxation in the 21st century. That was in May of this year. We have seen the Green Deal, the Fit for 55 package. And in the meantime, also the OECD was continuing its work. And we saw earlier this week, last Monday, we saw the publication of the proposal for Pillar 2 for the global minimum taxation. And only 2 days later, also the European Commission came with a package full of documents today. And that's what I want to talk with you about today, because a number of important documents were published, I think. Jean-Philippe, can you enlighten us on what was published today?
Yes, yes, of course, Peter. And there were at least four important documents published today and as well yesterday. The first one, as you mentioned, the Pillar 2 document, the draft directive that should implement Pillar 2 in the EU. As well, we have a draft directive for ATA called ATA 3 on shell entities. Next to that, we have new EU state aid guidelines that were published that should set out the framework under which EU member states can provide state aid to support transitions towards a green economy and implement the EU Green Deal. And next to that, we have as well proposals for an EU budget. So lots of things still published this week, I would say.
Yeah, wow, what a package. And of course, these podcasts are not a full day podcast, so we will need to focus a little bit in this one. And I propose that we start perhaps with the publication of on the Pillar 2 proposal, because that's, of course, a very important development for many of the listeners here. So the European Commission published a draft directive, of course. Is it completely in line with the OECD, or are there important differences, Jean-Philippe? Perhaps that's as a starting point.
Yes, indeed, that's a good starting point. And well, the Commission is clear. It explains that it is important to stay as close as possible to the OECD model rules. However, there are at least three important deviations, and as well that partly have to deal with EU particularities of EU law, such as the fundamental freedoms, but as well with keeping the sovereignty of EU member states. And the first important deviation is that where the OECD model rules apply to multinationals that are actively cross-border, so there's a need for a cross-border element, entities in separate countries, well under to avoid violation of the fundamental freedoms and discrimination within the EU. The directive will also or provides that the rules should also apply to strictly domestic situations. So a large company that only acts domestically. So that is one important difference. A second difference concerns the application of the income inclusion rule, which is yes, so we have to collect the top-up tax. We have the income inclusion rule under tax payment rule. Well, normally an income inclusion rule under the OECD model rules will in principle only apply as well cross-border. So only with entities, low tax entities situated in other countries. Well, similar as the previous deviation, to avoid discrimination and not infringement of the EU fundamental freedoms, as well, the income inclusion rule will apply in strictly domestic situations. So as well to domestic low tax entities. So these two deviations to make the model rules or these two deviations, the Commission hopes that the directive will be in line with the fundamental freedoms. However, there's a third important deviation, And that is that the directive will provide that top-up tax can be collected at the level of the country where the EU member state where the low tax entities are situated. And to make this clear with an example, imagine you have a Belgian headquartered multinational with a subsidiary in Ireland, low taxed in Ireland. Well, normally under the general mechanism of the globe model rules and the income inclusion rule, it will be Belgium that can collect the top-up tax with respect to the low taxed profits in Ireland. Well, now under the directive, the option is provided that Ireland can collect the top-up tax locally, so that it will not be Belgium that collect the top-up tax, but Ireland, and this to protect the sovereignty of EU member states. So I would say some, by and large, in line with the OECD model rules, but some important deviations.
Okay, thanks, Jean-Philippe. I would say for the audience, if you want to know more about the OECD proposal, we have a separate podcast on that, just as a recap for the listeners that want more details on what the OECD proposed. But okay, Jean-Philippe, quite some important differences. So yeah, Isabel, European Union as first mover again in an important tax policy area. How, from your perspective, how do you see the interaction between this proposal in the European Union and the rest of the world? Can you enlighten us on that one?
Yeah, thanks, Peter, and hi everybody. Glad to be here in the podcast. Yeah, it's interesting. Very ambitious implementation plan. The planned introduction is 1st of January 2023. Knowing that we have here a draft directive that needs to be translated, first of all, in domestic legislation. So it's perfectly plausible. We understand the political adagium behind it, leveling the playing field, building trust in the international tax architecture. But when it boils down to applying the technicalities, well, I guess there will be a few countries that will be surprised maybe about the effect of some of the rules. Think about how to avoid double taxation. It's a concern that might pop up. Interesting is that the Commission's proposal contains a provision to determine the equivalence of laws of some non-EU countries. This is where we have to think in a first instance about the United States and the so-called guilty global intangible low taxed income system, so their minimum taxation, and how that ties to the income inclusion rule. And so, what conditions a jurisdiction needs to fulfill before the EU grants the equivalent. So, it's a very interesting one. Also, politically interesting to see what's going to happen next year with the midterms. Interesting. And then there are a number of countries that are relatively silent because it's almost binary. You hear people talking about the EU, about the United States, but what about very important economic blocks of emerging countries that are relatively silent? But it will be very interesting to see as things are progressing, as somewhat relatively vague concepts under the directive need to be translated, what will be actually the proof of the pudding in terms of acceptance, Peter. That's what I see as a very interesting development to keep an eye on.
Okay, yeah, thanks, Isabel. So, yeah, Europe moving ahead clearly, or at least with a big intention to move ahead. And yeah, another area linking a bit to this, I think where Europe is setting an important step forward is also in the proposal to unshell companies. So the ATAT 3, based on what I read today, that is really a far-going proposal, isn't it, Jean-Philippe? That the European Union is publishing here, and against the background of first mover, this can count as well, I guess.
Indeed, Peter, this is yet another very important evolution. And with this ATA 3 or directive on unshell entities, the Commission wished to provide a new economic integrate a new economic substance test. And the idea is that this directive has a very broad scope, covering all all undertakings resident in the EU. So not only legal entities, but as well partnerships and which all entity forms that exist. There are different tests in this in the directive. And first of all, the first test will be identifying when there is an entity has a lack of substance and when there is a potential risk. And for this, three cumulative criteria have to be fulfilled. And first, more than 75% of the revenues accruing to the undertaking in the preceding 2 years must be relevant income. Relevant income is, for example, interest income, royalty income, dividend income. So the royalty passive, normal passive income flows, but also crypto assets, income from immovable property, and so on. Second, the undertaking must be engaged in cross-border activities. And third, in the preceding 2 years, the undertaking outsourced the administration of day-to-day operations and the decision-making on significant functions. And if these three criteria are met, the undertaking is regarded as a risk entity, and there are reporting requirements. What do these reporting requirements mean? Well, the company that poses a risk must declare in its annual tax return, so on an annual basis, whether it meets certain minimum substance indicators. There again, there are several substance indicators. For example, whether the undertaking has owned premises in the member state or premises at its exclusive use. Next, whether the undertaking has at least one own bank account and must be an active bank account in the European Union. And third, as well, whether the undertaking has at least one director resident close to the undertaking and dedicated to its activities. So there are several minimum substance tests, and importantly is that when you say, okay, we will fulfill this minimum substance, all these tests, they have to be documented. So it's not just saying fulfilled, but as well, it must be proven. If all minimum substance requirements are met, there is the presumption that it's not a shell entity. So there it stops then normally. However, if one of these minimum substance requirements is not fulfilled, there is a presumption that it is a shell, that the entity is a shell entity. However, the taxpayer can rebut this provision by either proving that there is substance, and again, there must be a substantive proof of this, or can as well demonstrate that there is no tax benefit, meaning that if the entity would not be interposed, the tax burden would not be lower. Apologies, would not be higher. So that's important one. That is burden of proof, and as well, if an important measure is there, administrative measure, that if you can prove this, then it can be agreed that this can be this approval is valid for up to 5 years. So that to reduce the administrative compliance burden.
So the European Union is really proposing an overview of the requirements that should be met as a company, not to be regarded as a shell company. And important, I think, to mention, Philippe, is that this is a change to the directive on administrative cooperation. So this information will also be shared within the European Union as part of that initiative. So, okay, and what happens if you do not meet the requirements and you are considered a shell company? Is the directive also proposing an impact for that?
Yes, yes. There are very important consequences. And the first one is that if you are regarded as a shell entity under the directive, well, then treaty benefits will be denied, but as well access to the directive, the parent EU directives, parent subsidiary directive, interest and royalty directive. So there's of course important consequences there. As you said, so this administration, because of course EU member states should be able to verify this and know when there is a shell entity. So information will be automatically exchanged between EU member states, and that at a very swift procedure will be implemented. And then there's an important aspect is as well, what if you're non-compliant with the procedure? So what if you do not report something? Well, there the member states are given a certain discretion to determine the sanctions, but the sanctions, according to the draft directive, will include an administrative sanction of at least 5% of an undertaking's turnover. So if you have important financial flows streaming through this entity that is through this what is regarded as a shell entity, the sanctions can be very material. So this is certainly an attention point.
Okay, that are indeed very significant penalties. And when would this enter into effect, Jean-Philippe, this directive?
So according to the directive, the EU member states should implement this by the end of 2023, so that it enters into effect 1st of January 2024, at least.
Okay. So yeah, clearly this is another first mover step, I would say, Isabel. Wouldn't you agree that this is also quite unique in the world? How do you look at this with your experience? Is Europe giving the right message here to business?
Well, you phrase the question in a very intriguing way, Peter, because first mover for what? What do we want to achieve here? And if we are talking about companies with weak economic substance, well, I would think that this is what the OECD G20 BEPS project wanted to deal with. It is the economic substance, as we all know, something that is not legally specified as a notion, but for which value creation is used as a proxy. So now all of a sudden I see lack of economic activity. I see, as Jean-Philippe was referring to, this requirement of this director, but they're not referring to the proxy of value creation that was extensively elaborated on under the BEPS project. So it's draconic. That's the least that one could say. Yeah? It goes very, very far, and it gives the impression that if someone incorporates a legal vehicle or sets up a joint venture, it can be whatever. You have to look at it through the lens of potential anti-avoidance, and this is where one could struggle with, because one could have so many reasons to set up a legal arrangement, a company, a joint venture, or whatever. And this is exactly also what we, as PwC, have submitted under the public consultation. We said, well, you have a number of legal vehicles, and insofar that a legal vehicle generates tax consequences, one has to see whether these tax consequences would potentially violate tax policy objectives. And anti-avoidance could be such a violation, and then you probably have a rationale for these sorts of measures. But this is not how I read this. This is simply well, sending a bazooka from the start. So very draconic, and yes, first mover. But well, I'm not overly proud of it as a European. But one sees definitely the impact of the political impact on, again, stressing how important it is, the fairness concept, and all these notions around that. But what I would say, Peter, as companies, what could we do? Well, the call for action is think about your transfer pricing compliance. Think about your master file. Be very specific about your economic substance to make sure that indeed you can counter a number of the deemed lack of economic activity allegations, I would say.
Well, thanks for that, Isabel. And I think that that's based on what I hear and what I read today, that indeed the conclusion is that these proposals will impact or have relevance for, I think, all businesses. We said that in the previous podcast on Pillar 2 as well. Even businesses who are active only in territories way above the 15% tax rate will be impacted because they will need to prove how the tax is calculated. They will need to prove exactly how much tax they pay in an auditable, verifiable way. And I think here, based on what I hear from you and Jean-Philippe, it's the same story. Companies will need to prove themselves, reversal burden of proof that they have the people necessary to do certain activities, that their transfer pricing is aligned with that, and so on. So I think impact is much broader than businesses that would have shell companies in the structure.
And also, Peter,
Mhm.
informing your stakeholders in the organization, the C-suite, the board, because this brings another perspective on the way you deal with your tax affairs. We have ATAT 1. I think in most organizations this is known. We have the multilateral instrument. We have the beneficial owner test. We have principal purpose test. And now there comes, as a sort of an overlay, something very draconian. And you need to make your board understand that this does not necessarily mean that you're engaging in anti-avoidance in anti-avoidance in a fairly aggressive way, I would say.
Mm-hmm. And the pace of change is enormously fast. So Jean-Philippe, you follow this very closely, all these developments. Is there going to be more in 22? Is this just the start of a number of additional developments in Europe, or how do you look at that?
Well, I think as well in 2022 we can expect still as well yet again several new legislative proposals. We have DAC 8 coming up with on crypto exchange of information on cryptocurrencies, harmonizing penalties. We have as well still publication of effective tax rates based on Pillar 2 calculations, draft directive that we are expecting as well. DBRA had a debt equity bias reduction allowance. We have the Fit for 55 package where we expect progression there. So as well, 2022, the European agenda will be packed.
Yeah. Okay, that's promising for the new year, I would say. Unfortunately, this podcast is a rather short one, so we've come to the end of the podcast. But I have one last question for both of you, and that is a very short one. If you could give a last message, perhaps of hope for the audience that is listening to this podcast, what would be your key message, your recommendation for the listeners of the podcast? Isabel, Jean-Philippe, don't know who wants to go first.
I'm happy to go first, Peter. Well, the hope, well, if you do the modeling, and there is now already some more information than where we were just with the launch of the work of the inclusive framework back in October. The OECD delivered this week. We have now also the Commission who delivered. There is now more opportunity to think about the data points you need to start with the modeling rather sooner than later. And that, I think, would give you some comfort and at least some mental rest.
Indeed, and if I can add to that, besides modeling, I think as well what is important is certainly to the monitoring. So the monitoring all these evolutions and as well which impact the strategic impact of all these evolutions and how to adapt your business structure to all these evolutions.
Okay, thanks a lot for sharing that. And as I said, we reached the end of the podcast. So I would really like to thank you for immediately joining me for this podcast, for having read the documents and give these first reflections to the listeners. Highly appreciate it. And also for the listeners, thank you for tuning in. We know a lot of developments are happening. We try to stay on top of them and stay tuned, I would say, with the podcast series. And we'll make sure that you get the latest insights. Thank you.